Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. We are going to take a look at the four major U.S. indexes, the dollar, commodities, as well as the emerging markets. But this week, we're really going to focus in and pay attention to what's going on in the rate space. And we're also going to talk a little bit about margin debt growth and what that means for us when we take a look at it through a historical lens. Well, let's jump right into it first. S&P 500 did make a new marginal all-time high after the Fed meeting yesterday. However, pre-market this morning, I'm recording this on the Thursday, the 18th, before the bell. The S&P 500 is actually back down about 0.8%. The Nasdaq is down almost 2% overnight. The Dow is about flat, and the Russell is down about 1%. And again, we're seeing that tech space get hit a lot harder than other areas of the market when we start worrying about rates. If we take a look at those daily charts, the Russell 2000 still up near those all-time highs, looking extremely strong. The Nasdaq, of course, has been the issue, was the weakest here over the last month or so, ran right into this resistance zone in at 13,200, and that's where it failed to push above. This morning, it is back down, actually about right here. In the futures market. So that's really the big hurdle for the Nasdaq to get over. If you get over that, then you're looking back towards those all-time highs, and that would be bullish. But we need to get over that 13,300 zone before we can really start looking at those all-time highs. Let's take a look in now at the Dow here. You can clearly see the difference between this chart and a lot of the other charts that we've just pulled up index-wise. Not only did we make a new high about a week ago, we've continued to push up. So Dow is kind of that leadership, and we are still seeing that rotation. We've talked about rotation week in, week out here for the last month or so in these videos. That theme is certainly still in play. So we're seeing all of the areas of the market that really struggled last year. The reopening trade is what's taking advantage right now. So growth was really strong last year. This year it's flipped back towards value names to play kind of catch up. And we've got the Dow leading us higher. So that hasn't changed. Let's take a look in at the U.S. dollar real quick. The U.S. dollar, all right, we still have that major resistance zone in between that 92.5, support back around 91. We're still chopping around, haven't really made much stride either direction here, and we're continuing to watch this very closely. It's a very long-term important level. We've discussed this in depth in a number of videos. What I really want to talk about here is rates. Here are our 30-year bonds, and we can see we have clearly broken down below that last key zone of support in there about that 155.19 and that 156 zone, and have continued to head lower after the Fed meeting yesterday. All right, Powell left rates unchanged. But we are still seeing real rates rising, which, of course, as we know, is inverse to what the bonds are doing. So as yields rise, bond values fall, and that's what we're seeing right here. When we look at the bond market, the next area of support is a big one. It is a very key level that goes back to 2017 and 2018. Underneath of that, we could see a move all the way back down towards that 136 area. Now, it's not the fact that rates are rising that's the problem. It's the speed in which it is happening. Remember, the markets can adjust themselves if rates are rising slowly or falling slowly over time. It's easy to adjust. What markets have a difficult time dealing with is when we have a quick move in rates. And that's what we've seen here. Over the last month or so, we have had a very large move, and that, I think the market was really looking for Powell to kind of stem those fears in the meeting yesterday, and he really didn't. Left everything kind of unchanged, and we saw overnight this continue to push to the downside. So we are going to pay very, very close attention to what continues to go on in the bond market. I think it's very important, especially when we look at what's going on in the tech space. Now, let's look at some commodities. Let's jump in and let's look at gold. Gold initially had a nice move up towards that 1750 zone. That's being faded here today. And we're really kind of trapped in between that 1675 and that 1775 zone in on gold. We're waiting for that next move. Gold absolutely needs to hold that 1675 zone, and it would be very bullish if we were to get back up over that 1770 zone. We take a look in at silver, still fighting around in between 26 and 27. Held up a lot stronger than gold, continues to do so. We've talked about that in depth here for a while. Platinum's acted really well, back up near those highs, and we finally have a move out of palladium. Palladium, which we have been watching for that break over that 2,500 zone, it happened yesterday. It's continued to have a follow through. It's actually up over 5% here Thursday morning before the bell, nearing those all-time highs. So we could really be seeing that move out of palladium here, and that's something you definitely want to pay attention to, because it's gone nowhere essentially since last July. It's made a nice tight range, and this is a clear breakout, and it has happened here on large volume. So we will look for that to continue to follow through here to the upside. Let's look in at copper. Copper continues to hold up, pulled back into that support level at 390, has bounced back up, still holding over 4, so that in and of itself still looks pretty solid. Let's look in at oil. Oil is the one I really want to pay a lot of attention to. We back this up, and we've talked about this level a lot. This 65-ish zone is really, really important going back a number of years. We pushed up right into that and have started to kind of roll back over. No concern really until we make a lower low, which means we'd have to take that 59 out. But this is an area that we've talked about as a potential zone for failure on a technical basis out of the oil market. If it does get up above that, 75 is that next upside target. But this is not a great spot to run into weakness and failure, because that's the exact spot that we failed at the beginning of last year before that major slide, and then also once again in 2019 on that bounce. So this is really, really important multi-year level in on oil, and I think what happens here is really, really important to pay attention to moving forward. We look at the emerging markets, still green for the year, holding up. And really, as long as they stay over that 1275 zone, that looks really good. If you're breaking down individual countries, there are some individual countries that are outperforming the emerging markets in general right now. One good example of that would be India, that has continued to be extremely strong. It's up near those 52-week highs. Didn't have nearly any sort of a dip like we saw out of the majority of the emerging markets. That's an area of the market I think you should continue to pay attention to. Let's talk a little bit about margin debt. Now, this chart from Sentiment Trader goes all the way back to the 1930s, so we have a lot of years that we are paying attention to here. So there's a lot of good data there. You can see very few times do we see that margin debt get over that 60% level. When those numbers come out here shortly, it's projected that we're going to be looking at about a 73% margin debt ratio. All right, and that is in that very rare kind of historical spot in terms of margin debt. So we're going to take a look at what those actual numbers can mean for us. When we go back in time and we take a look at that margin debt year-over-year growth, when it's above that 60% ratio, which is showed on that last chart, the numbers do not bode well for the next year for the S&P 500. 1 month, very negative. We get 3 months out, it's a positive skew. 6 months out, it's still a positive skew. Then we get 9 months and a year out, we do have that below 40% with a risk to reward favoring the bears in this particular example. And it makes some logical sense when you are looking at what margin debt really is. People are borrowing money to make bets upon stocks. And when that growth continues to happen, eventually you get to a spot where you can't borrow anymore, you run out of buyers, and the tides tend to turn. Now, the one thing I really will note with this is outside of 1972, none of the historical stuff from the 80s, 70s, 50s, 60s, 40s really have a big negative associated with them. This is the last two times that this happened was in the late 90s and in 2007, and that's why we have these very, very big negative skew numbers here a year, 2, and 3 years out, because that actually marked the top of the bull markets, the last two. So what I will say with this is anytime we get a data set that shows us, when we look at 100 years worth of data, it pops up in 2000 and right around that 2000 bubble crash and the 2008-2009 financial crisis, it's worth paying attention to. But historically, outside of the last two times, this has really not been nearly as negative as these numbers look on the surface when we go back and look going back over the last 100 years, right? We actually have a few really positive examples in there, and the negatives were like negative 10%, negative 5% versus negative 14%, and then 2 years later in, '07 in 99, negative 40%, negative 20%, right? We again had that issue in the 70s, but other than that, we had big growth over the next 2 to 3 years. So speculation was rampant. You had a little bit of short-term pullback, but then things really were good, and we had that big kind of expansion for quite some time. So, it's another thing to take a look at. It's another thing to chalk up in our minds of, okay, we've had a lot of speculation as of late. What could that mean for us moving forward? But as I've continued to talk, looking at these historical data points, I hate the term this time might be different, but in reality, we've never been in a world where we have printed the kind of money that we have here in the last decade. So a lot of these historical data points that may look extremely negative may not hold the same weight that it once did, as we really have changed the rules to the game, so to speak. As always, I hope you guys found this video helpful. If you want, you can reach out and reach me at mtedeschi at Perspective Wealth Planning, or you can give me a call at 814-580-9881. Love to talk anything about the markets with you guys. I hope you have yourself a fantastic week. I'll see you next week.